Hey everyone, welcome back to Corporate Decoder, the place where we decode the documents that Wall Street loves to bury. Today, we're cracking open Ares Industrial Real Estate Income Trust's annual report, so buckle up, because this thing is drier than the Sahara Desert. But don't worry, we'll find the oasis of information hidden inside. This year, AI REIT is trying to convince us that it's still a solid income play in the ever-shifting landscape of industrial real estate. But are they really delivering the goods or just stacking boxes of promises? Let's find out. Right off the bat, it's a Form 10-K, meaning it's the big annual overview. Ares Industrial Real Estate Income Trust, trading under the catchy ticker NONE because, well, there's no public market for it. They're structured as a REIT, a real estate investment trust, so they're legally obligated to pass along a lot of their income to shareholders. That can be good, but it also comes with its own set of rules. One thing to note, they closed the offering of new shares in the summer, but they're still selling stock through their Distribution Reinvestment Plan, or DRIP. That's where your dividends automatically buy more shares. It is also doing a private offering, which is exempt from registration of shares of Class SPR, Class DPR, and Class IPR common stock. AI REIT is supposed to be all about high-quality distribution warehouses and other industrial properties. Think big, anonymous buildings where goods get sorted and shipped. Although they can invest in other types of properties, but their focus is industrial. As of the end of 2024, they've got a portfolio of 255 buildings, sprawling over about 54.7 million square feet across 30 markets. Now here's a number that jumps out. Their average rent growth on renewals clocked in at 61.4%. Now, that's not a typo, but important to note that's the cash basis and the GAAP basis was a bit higher. Also, a reminder, that's just the average, so individual buildings could be doing better or worse. Here's a big red flag: no public market exists for the registrant's common stock. So if you want to get out of the investment, you're basically stuck with their share redemption program, which, as we will see, is not exactly known for its liquidity. Their share redemption program sounds nice, but it has limits. Each month, they'll only redeem up to 2% of their total NAV, and each quarter it's capped at 5%. Also, if you haven't held the shares for at least a year, you only get 95% of the share price back. The board can also suspend or change the program. To keep the redemption program going, they have to hold more liquid assets than they might otherwise want. So if you thought they were all about warehouses, think again. They keep a significant chunk of their money in more liquid, lower-return investments just in case people want to cash out. They point out returns over a limited time frame may be presented, and that is inherently limited in its applicability to the future. So, historicals are great, but don't expect them to magically predict the future. There's also the performance component of the advisory fee that's calculated on the basis of the overall investment return provided to holders, and is not always tied to the performance of specific shares. Plus, there's a cumulative loss carryforward. As for who's steering the ship, all of the key people are also key people at the advisor, which is run by Ares. That creates potential conflicts. And remember, they have to compete with other Ares-backed entities for investments, which may put them at a disadvantage. The independent directors have an obligation to act in the stockholders' best interest and as a fiduciary. Investing in real estate is inherently risky if the tenants can't pay or if a building sits empty. The investment is also exposed to regulatory and legal changes, including changes to rates. They could get slammed by natural disasters or, worse, terrorist attacks, and their insurance may not cover it. They also note that there might be terrorist attacks, unrest, or war, and these may affect the markets that the company operates in. Cybersecurity is also cited as a major risk, with the potential for attacks disrupting operations and/or damaging their business relationships or reputation. Also, there's significant risks associated with failing to comply with regulations surrounding consumer and stockholder info. Geopolitical instability, including actual and potential shifts in U.S. foreign, trade, economic, and other policies, the war between Russia and Ukraine, and the conflicts in the Middle East, have created macroeconomic uncertainty at a global level. They admit they are affected by interest rates and the policies of the Federal Reserve. Plus, increasing inflation is never a good thing. With all that being said, let's quickly look at some numbers. Aggregate fund NAV as of the end of December 2024 was approximately $4.3 billion, with a cumulative loss carryforward of $1.38 per fund interest. This loss carry-forward has to be realized to offset positive returns before the advisor makes any money. Also, the special unit holder needs the overall return to exceed 5% and the loss carry-forward amount before getting that payout. So you can see who has the best position to weather this storm. They can change their investment policies without asking anyone, so you're putting a lot of faith in their team. So what's the takeaway from all this? Ares Industrial Real Estate Income Trust faces both challenges and opportunities. On the one hand, it's navigating a complex economic environment with high interest rates, the threat of recession, and geopolitical risks. Also, their reliance on an external advisor creates potential conflicts of interest and limits their control, along with high debt loads. On the other hand, the industrial real estate market still has pretty solid fundamentals, and Ares has a huge portfolio with some pretty big-name tenants. Plus, the loss carry-forward provides a buffer that investors can realize before the advisor collects a performance fee. The big question is, can Ares navigate these risks and achieve its long-term goals? It really comes down to how well Ares management navigates these risks and capitalizes on the industrial market's enduring strengths. What's my verdict? For most retail investors, this looks like a risky play. The returns aren't great and they are risky. You're also pretty much locked in since this thing doesn't trade on any exchange. Thanks for watching. If you found this helpful, please like, comment, and subscribe for more corporate decodings.